Hello and welcome to CNBC TV 18. The budget fine print discussion continues. I'm Surabhi Upadhyay. This is our special presentation where we will try to decode key tax-related headlines from Budget 2018. And to do that, I have with me, of course, Lata Venkatesh in the studios. There are lots of tax issues to go over. And our star-studded panel of guests. Feroze Azeez of KPMG India, Sameer Kanabar of EY, Ketan Dalal of Catalyst Advisors, and Feroze Azeez from Anand Rathi Private Wealth. So thanks very much for being with us. Thanks for joining in. Lata, I think the budget threw up lots of announcements. I mean, for the salaried individuals, no change in income tax slabs. But as we're finding out in the fine print, when it comes to our share investments, our mutual funds, I think there's a lot that still needs to be learned and, clarified.
Yes, and we don't have too much time, so I'm starting straight away. Feroze, first LTCG, the long-term capital gains on shares. The base price will be yesterday's closing price, or will it be yesterday's highest price? That is the first doubt people have. And if I sell tomorrow, day after, will I be taxed? Or will I be taxed only if I sell after the new year is born, that is April 1st?
Correct. So the point one, it will be the highest price discovered on yesterday's trading hour.
Oh.
Point two, you would only be paying tax provided you sell it in April.
Okay.
And long-term capital gain for the period would be computed from the date of your purchase, not 31st January.
Okay. So to just take that point forward, Mr. Dalal, a lot of people will now wonder what to do because the base price can be either the original cost of acquiring those shares or the 31st of Jan cutoff. Now, for the next 2 months, investors are going to wonder, should I book my past profits? Should I just stay on? What do you think? How will this play out, both on mutual funds as well as listed shares?
See, I'm not a stock market person, or in that sense, the investor will take his own call. But I would suspect that if there is a significant gain, Surabhi, he will be tempted to book that because it is exempt, and he may again buy it back, as it is the market is currently trading at virtually its all-time high, and it has gone up by 27% in one financial year. So there will be, to my mind, a tendency to book profits in the month of February and March.
No, but even if he stays put, he is, I mean, he will be taxed anyway if he sold it after
but
April
the market,
1st.
though, correct, but the market may go down, no? In any case today, the situation, Lata, is that there is a temptation to think that has it sort of peaked out, is there much steam left? So again, I'm not a stock market person.
No, let me come to then the other problem which a personal, from a personal taxation angle, we all have. This tax on dividend from equity mutual funds. Does that, how does that kick in? Will you see people moving out of that fund? Will it be taxed by, will I get tax deducted? How does it work for me?
So if there's dividend tax will impact three categories largely. Dividend is going to be always deducted at source, and whatever dividend you get is going to be tax-free in your hands. Just like any debt scheme used to have dividend distribution tax, now equity schemes will have dividend distribution tax.
So when they show the NAV, they will show it tax deducted? How will the mutual fund show it?
See, in dividend there are two. One is payout, one is reinvestment. Reinvestment will show post-dividend distribution. Payout anyways comes to your account. Growth anyways doesn't have dividend. So dividend reinvestment, like you rightly pointed out, will show post-tax growth in the NAV. Okay. What will change is arbitrage funds, which has a lot of liquid monies, which are 1 month parkings, will now have to change because the equity taxation is, dividend is 10%. Arbitrage used to enjoy zero taxation there. Balanced funds had a mandate of keeping more than 65% in equity, which now I think fund managers will relook and bring it to 50-50 because debt taxation is as good, or debt taxation has indexation as per Section 48 still. So I think these are the three categories: equity, arbitrage, and balanced, which will require some degree of, in fact, a large shift, a paradigm shift in the way how fund managers have thought about it.
That obviously becomes very important because, as you're saying, for balanced funds, where the bulk of the money was flowing in the last couple of months, there could be a sort of a offloading of equity and maybe a move towards debt. But there also the benefit kicks in only after 3 years. If you stay invested in that fund for 3 years, then you get the indexation advantage, which is not there in the new capital gains tax regime.
Correct, because if you reduce your exposure in equity from 65 to 50, then you are, as per definition, a debt scheme, and 3 years is a reasonable period. In fact, the entire retail folios out of the 6 crore folios, which the mutual fund industry currently possesses, almost 2.5 years is the holding period, average holding period.
Okay.
So that's not too far away from 3 years. If it was 1 year holding period, then this would not be a big advantage.
We could see a preference for debt on the part of fund managers. Okay, Mr. Dalal, let me come to other issues, mainly MAT and IBC related, bankruptcy code related. What are the changes?
So there are 2 changes, Lata. One is that the finance minister had announced, there was a press release actually on the 6th of January, that in relation to IBC companies which have applied to NCLT, brought forward loss and brought forward depreciation, both would be set off as opposed to the lower of the 2, which is in the normal situation. Both would be set off in computing MAT. That's change 1. Change 2 is there is a provision called Section 79 in the Income Tax Act, which basically says that if there is a 51% change in shareholding, the brought forward loss will not be allowed to be carried forward. So it's clearly a disincentive for somebody who wants to take over such a company because he's taking a risk by taking over such a company. So this has now been amended to say that Section 79 will not apply. However, on the first point, I want to make a larger issue, Lata, which is this. In the context of a haircut taken, say, by a bank or a financial institution for an IBC company, we spoke about MAT. But the controversy as to the haircut written back, whether it is income or not, still continues. There is a whole kachina of case laws, some saying it's taxable, some not taxable. Majority says it's not taxable, but in the interest of, so to speak, furthering the process of IBC companies better, I wish that this had been clarified, and there's still time between the bill and the act to clarify that such a haircut also should not, because it's not in the nature of income in the first place.
Sure.
So
Samir, you want to add anything to that with respect to taxation and making the whole IBC process a little more easier, more successful? Has everything been done with these 2 changes, you know, both for unlisted companies as well as listed companies?
No, so again, I mean, the challenges, as Ketan bhai mentioned, continue as to whether the haircut or the write back of the principal, which either goes to P&L or to capital reserve, even if it doesn't go to P&L because of the so-called Ind AS legislation, that poses a tax challenge, and that entire amount could be subjected to tax. So of course a lot of representations have been done. We believe that maybe in the finance bill there may be an amendment coming to address this situation as well.
That if it is taken to the capital reserve, it should not be taxed.
It should not be taxed.
Okay. Parizad, what are we leaving out over here? Is there some other fine point that that is changing the tax world, or do you want to add only to the IBC cases?
Well, Feroze is the, let me say, the personal taxation expert. So I'll ask you this. I mean, the original announcement that came in of this return of standard deduction made us very happy, 40,000 rupees.
Right.
It's not as good as what we thought at first glance, right?
Sure. So I'll take you back to 2005, 2006, which is around roughly 13 years back. If I look at the landscape at that time from a salary taxation perspective, there was a flat deduction of around 30,000 standard deduction. But coupled with that, we used to also get as salaried payers a transport exemption of around 800 rupees per month and a medical reimbursement of around 15,000. The transport allowance exemption currently was around 1,600 per month. So 13 years back, if I sum up the two, I could possibly get as a salaried payer around 30 plus 15 plus that 9,600 of conveyance, which was more than 40,000 what is being offered to me now as a flat deduction. So on one hand, I do have 40,000. On the other hand, I'm sort of clawing back the conveyance and medical, which is roughly around 34,200 as it sums up to be. So my incremental reduction in my income is 5,800 rupees annually.
Okay, but then you don't have to give bills, so that's a very big
that's what the speed
administrative
says,
hassle.
Ease of compliance. If you ask me from a personal tax relief in my hands as my net disposable income for salaried payers, it goes up by 5,800 annually. So the quantification of tax, to be sort of precise, 302 rupees annually, depending on your tax bracket, to around roughly 2,000 plus That's your effective tax savings.
But overall, would you call it disappointing? I mean, as every year, income taxpayers, salaried earners, we go in with a whole list of expectations.
Yeah.
ATC, nothing done. NPS, nothing done.
Yeah.
The insurance sector was really hoping to get some sort of additional carve-out for life insurance, specifically term insurance.
See, the agony always for salaried taxpayers, and I think he quoted it in the speech also, that there's a general perception that there is no level playing field or a parity between, say, a businessman or a professional who perhaps gets deductions against the income vis-a-vis a salaried taxpayer. I think the problem to do is also with the expectations of people, but definitely there's not much in terms of, savings of tax, rates or any slab rate changes that people got used to in the last 3 years because there was some tinkering with the personal slab rates. Senior citizens is what he's touched upon, but yes, you're right. And, the crowded ATC limit, which we talk about practically every year, and maybe for the last, I don't know how many years, those things have not seen any changes.
Okay,
I just want to give a different perspective, that a lot of, actually, this is coming out of representation. So a lot of representations were done that do away with these allowances and give one single lump sum reduction. And of course, there was no quantification that whether it should be what amount. So obviously this is coming out of,
see, the agony.
and of course there was no quantification that whether that I have to claim allowance, I have to claim medical bills, etc. Make it this simple. The other aspect is that 1% extra cess from 3 to 4% is actually causing a problem.
Yes.
So
We pay more tax because
rate has gone up.
in spite of giving this relief from 40,000, and it's, as
That
maths work
5,000,
out, that 5,800 is the
eaten up by
savings,
cess.
is a savings. But the moment you cross certain threshold as a break-even point because of 1% cess, it takes away the entire
Did you
charm.
calculate the break-even point?
Roughly it comes to, of course, which I believe everybody will be beneficial, but it comes around 12.5 to 13 lakhs per annum. So it's
For that
still,
level
So
of
that, I think we have to take a break, but this is the bad news. If you are earning under 13 lakhs, you're probably saving 5,000 rupees. But if you're earning over 13 lakhs, your tax outgo is going to increase because of the additional 1% cess for medical and education purposes. We have to take a break on that note, but this discussion is just hotting up. We are back with more on the tax fine print.
Welcome back. This is the budget fine print, and we are talking taxes. Several announcements coming in, not exactly the ones that salaried taxpayers or India Inc. were expecting, but important announcements nonetheless. Well, gentlemen, I want to now, throw the spotlight on the reduction in corporate tax rate, not for everybody, but at least enterprises with turnover of 250 crore rupees. Mr. Dalal, does it really serve the purpose? I mean, what do you think the benefits could be to the MSME sector?
I think, Surbi, the benefit is substantial. Let's be honest about it. The reduction from, first of all, it's not 25, because if you add surcharges and all, I think it comes to roughly 29, because remember there's a 1% increase in cess. So 35 to 29 is a significant benefit, and as the finance minister said, about 98-99% of Indian companies will be covered. So the benefit is very significant. Also, although the fine print I have not gone through fully, my understanding is that earlier it was only relevant to newly formed companies. That is no longer the case. It is applicable to all companies. Earlier it was for manufacturing, now it goes across. So the funnel has broadened significantly, number one. Number two is, obviously it does not apply to the larger companies beyond 250 crore top line. And I just want to point out one statistic. If I remember rightly, about 1% of companies pay 50% of the tax. Now, they are also the companies who can generate significantly more employment. And if you look at the employment issue in India with 12 million people coming into the workforce every year, that is a big disappointment, especially when you see global tax rates. I'm not even comparing what Donald Trump has done in the US or UK. I'm talking about, let's say, China, which is relatively, we compare all the time with China, right? There the rate is 25%. So even from a global competitiveness point, that's not very good. And the third and the last point on tax rates on the corporate side is, you reduce it for corporates, but a lot of MSMEs are in the form of partnership firms or LLPs. Sure, they don't pay dividend distribution tax, but I don't think that distinction should have been made. I think if you really want to encourage MSMEs and say, okay, they are also creating a lot of employment, I don't think the treatment of LLPs and partnerships at 35%, whereas the company brothers are paying at 29% appears to be fair.
Okay. Well, Sameer, anything else in the corporate space that you want to highlight? Anything on base erosion, profit sharing, or any of profit shifting?
Yeah. So there are 2-3 things. One is, of course, on the domestic corporate. There were always those payments for discontinuation of a business. Say you are selling your business and you get payment, and there was always a controversy whether it's a capital receipt or revenue. So now they have clarified that if there is any termination in the terms of the contract for discontinuation of business, then that whether it is revenue or capital, it will be still taxable as business income. And if there is any payment being done for termination of your employment, then that will be treated as income from other sources, and that is how it will get taxed. So that's clarification they have done, and they have sort of overruled certain jurisprudence where it said, okay, these are capital receipt in nature and should not be taxable.
There's also the point on certain foreign entities that have a permanent establishment in India,
Yes.
and if they are still sort of conducting certain activities outside the Indian territory, whether that will be taxed or not. So, you know, do you want to sort of throw some light?
Yeah, so I think
if that's going to impact MNCs, which have, you know, a PE in India and they're conducting business.
So they have brought 2 major changes. One is they have got e-commerce taxation. So all these websites where you don't need a physical presence in India, you are hosting it from wherever. But if there is a certain amount of turnover and they have not specified, which is yet to be notified, and if you cross that threshold of that turnover by selling or buying goods or services, then that will be subjected to tax in India, even though you do not have any presence in
So
India.
this is the
Amazon
Google
will be
tax.
taxed.
This is the Google tax that we were always speaking of.
No, this is
Would it
slightly
be?
different from Google because this is relating to sale of goods, services.
I mean, would it not be an Amazon tax then?
It will be in a way, but yes, there is Amazon India, which is anyway paying tax.
Okay.
But if it is Amazon.com, which is non-Indian website, that is where this will get triggered. So it's largely for non-resident.
Okay, so they will they be able to tax a foreign entity?
Yes, that is the artificial amendment that they have brought in the act. But of course, there are tax treaties. So what they are trying to say is that there was an overall BEPS project under which there was Action Plan 1, and this is coming out of Action Plan 1. Most treaties have signed MLIs, which is multilateral instruments, say 100 odd countries have signed. Of course, this specific aspect is not covered in the MLI. So it will get amended in bilateral treaties and it will not be part of MLI. So long as today treaty does not tax it, you may still have a shield to say that can you override the act and go under the treaty and claim a protection. So that's one part of the PE taxation. And another is, they said that if you have an agent in India and if that agent is concluding your contracts, then today only if that agent is dependent on you, on the foreign principal, then the foreign principal was deemed to have a permanent establishment in India, and hence the foreign entity was taxable. Now they are saying that even if an Indian agent is not concluding contracts but is playing a lead role and is negotiating still a contract which ultimately the foreign entity is signing, even in those circumstances this would be taxable. And again, this is coming out of Action Plan 4.
They are broad-basing it on an endless
But it's part of the BEP, it's part of
It's
the
part of
MLI, so
BEPS.
it's part of a global framework that India is a signatory to.
Yeah,
so it
but you
shouldn't
know, Surabhi,
raise eyebrows, right?
No, I'll tell you. The problem in India, very often, unfortunately, is not the law, but the way it is implemented. So what happens is that, you know, you may have a global kind of framework within which some amendment of the type that Sameer explained is made. My concern is on the ground it will be interpreted, you know, even much broader than this. Number one, and number two, because of the way that the tax litigation in India goes on with, you know, very undefined time frames, the uncertainty that can arise is significantly greater. And this may look like a procedural point, but on the ground with 3 decades of experience, I can tell you it's a huge issue because
So we may
the
lose
uncertainty.
we may lose some points in ease of doing business.
Absolutely.
On this issue.
Absolutely.
Okay, we have only about a couple of minutes to end the show. So Feroze, anything on the mutual fund front that you want to advise the investor or point out as a trend?
Correct. So there are 2-3 things. One is this 1 lakh, lower than 1 lakh limit, which is not being spoken about too much. If I had invested a 5,000 rupee SIP 5 years, I'm actually not in the LTCG bracket at all. So that's one. Second is investments. This tax is very different than other tax because you can defer it till exit. And generally, if you invested for 10 years and your goals are 10 years away, your tax would not be 10%. It would only be 6% on a compounded basis. So these are the 2 points. And one important point, Section 43(5) includes agri derivatives, which has kept seeing an increase in the volume as non-speculative but business income. So that was another risk of dealing with agri commodities. Your taxation was very detrimental. Now it's come back to the more reasonable format like equity derivatives.
Parizad, I want to just clarify one point on health insurance. The limits have gone up for senior citizens. They get a higher deduction also on the interest they're earning on FDs. But on health insurance, do only senior citizens get the benefit of these higher deductions? Or can, let's say, I, as an individual who's buying health insurance for my parent, because I also was enjoying some exemptions on that. Is it applicable in those cases?
Yes, so I think currently you were getting around, I think if I'm not mistaken, 30,000 plus an extra for the senior citizen.
Yeah.
So that is further enhanced because the limits for senior citizen, so I could be a senior citizen paying premium for myself and for my, if I happen to have senior parents as well. So both ways the incremental for senior citizen.
Whether the child is paying that premium or the citizen himself is senior citizen.
Both ways.
So under 80DD, we can claim more exemption.
Yes.
Okay. Is there a limit? Or
50,000.
50,000 it's gone up.
30,000
so it depends.
has become 50,000.
There are two sections. One is for a health insurance premium, as Surbhi said, for 80D, and then the other was 80DDB, I think, which was for specified critical illnesses.
That's gone to 1 lakh, I think.
That's gone to 1 lakh.
That's some relief for people who are anyway suffering those
for
ailments.
prescribed ailments.
Okay. Well, so there are some tidbits that have been thrown in for health insurance. And if you're earning under 12 lakh, then there is a 5,000 rupee gift from the finance minister. Otherwise, for a personal income taxpayer above 12 lakhs, the taxes have actually gone up. For the corporate, there is relief if you are under the 250 crore revenue category. Even there, not if you're a partnership, but over that, no relief. In fact, extra tax in the form of the cess for education and medicine. And of course, chances are that if you're a foreign entity, you're going to undergo a little more problem in terms of trying to explain how your agent is positioned. All told, not too much by way of relief, but then this was always expected in the election budget. Thanks a lot for watching this special edition on taxes.